The global financial system is currently navigating a period of silent turmoil that mainstream media outlets choose to ignore, mesmerized as they are by the everyday noise of retail stock markets while the fundamental foundations of the global economy fracture beneath the surface. Over the past several months, key macroeconomic indicators have been flashing bright red, signaling a systemic transition of historic proportions that only the most seasoned institutional investors appear to anticipate with an unsettling level of strategic calm. This reality, largely invisible to the general public, revolves around a profound structural imbalance in sovereign debt and a progressive yet irreversible loss of confidence in traditional fiat currencies, initiating an unprecedented geopolitical and monetary turning point since the official abandonment of the gold standard. To truly understand what is transpiring behind the closed doors of central banks and major financial institutions, it is imperative to retrace the origins of this chronic instability and analyze the relentless mechanics of economic cycles that are currently closing in on our era. Global monetary history teaches us that every major superpower ultimately accumulates a level of debt so unsustainable that the system collapses under its own weight, paving the way for a new economic paradigm that is often brutal for uninformed savers. Today, the United States and major Western economies face an insoluble mathematical equation where debt service consumes an increasingly gigantic share of national budgets, leaving governments with virtually no real fiscal maneuvering room. Confronted with this mathematical impasse, monetary authorities find themselves trapped in a vicious cycle where the only apparent option lies in massive money creation, fueling a lingering inflation that quietly erodes the purchasing power of ordinary citizens. It is precisely within this context of widespread distrust toward paper currency that central banks in emerging nations and major institutional players are executing a quiet, historic pivot, massively redirecting their strategic reserves toward tangible assets, universally recognized for weathering systemic storms. Gold, in particular, has just crossed historic milestones unseen in 144 years, sending a deafening warning signal that lucid analysts interpret not as a simple transient speculative surge, but as the direct symptom of a profound systemic distrust in the long-term stability of the dollar and other global benchmark currencies. The mechanics driving this massive accumulation of bullion extend far beyond standard portfolio diversification, acting instead as a fundamental hedge against an impending geopolitical realignment where the hegemony of the petrodollar is actively challenged by multilateral economic blocs. For decades, the structural dominance of the United States dollar has allowed American administrations to run unprecedented deficits with near impunity, exporting inflation abroad while leveraging international trade networks as an economic weapon through sanctions and financial exclusions. However, recent escalations in international friction and the weaponization of central bank reserves have accelerated a dangerous awakening among developing nations, particularly within the BRICS alliance and energy-rich sovereign states seeking to insulate their national assets from foreign control. By systematically replacing U.S. Treasury bonds with physical gold, these nations are quietly engineering a parallel financial architecture designed to bypass Western clearing systems and mitigate the catastrophic risks associated with holding foreign fiat currency reserves vulnerable to sudden seizure. This subterranean reallocation of global capital represents a structural tectonic shift, moving away from centralized unbacked liabilities toward hard assets that require no counterparty trust, thereby fracturing the unipolar monetary order that has dictated global commerce since the Bretton Woods Agreement. As central banks accelerate their acquisitions at a pace not witnessed in generations, they are voting with their capital against the long-term solvency of traditional sovereign debt instruments, signaling to perceptive market observers that the current monetary architecture has reached its ultimate structural limit. This structural transformation within international reserves inevitably filters down to domestic economies, where ordinary citizens are left holding the bag as inflation and mounting public debt systematically dismantle their purchasing power. While institutional giants and sovereign states protect themselves by hoarding precious metals, retail investors and the broader working population remain dangerously overexposed to an inflated banking system that rewards reckless fiscal policy at the expense of individual savings. This growing disconnect between Wall Street indicators and Main Street reality creates a volatile psychological climate, driving widespread public anxiety and fueling a profound mistrust in traditional financial institutions that were once trusted blindly. When people realize that their hard-earned money loses value every single day simply by sitting in a standard bank account, a psychological shift occurs, transforming passive consumers into active seekers of alternative wealth preservation methods. This awakening is precisely why educational platforms focusing on macroeconomics and asset protection are seeing an unprecedented surge in viewership, as individuals desperately look for clear, unfiltered guidance to navigate the impending economic turbulence. By understanding the mechanics of how central banks manipulate interest rates and money supplies, everyday citizens can begin to take proactive steps to safeguard their financial futures instead of remaining passive victims of macroeconomic policy failures. However, recognizing the problem is only the first step. Taking action requires a deliberate strategy to reallocate capital away from fragile traditional instruments toward assets with intrinsic, undeniable long-term value. This brings us directly to the core mission of channels like the Wealth Outline, dedicated to breaking down these complex financial realities so you can stay ahead of the curve. If you want to make sure you never miss a crucial update on how these global shifts impact your personal portfolio, take a moment right now to hit that subscribe button and join our growing community of forward-thinking investors. As this tectonic shift accelerates, the consequences of unbounded national debt are beginning to manifest in ways that even mainstream economists can no longer sweep under the rug. The sheer velocity at which sovereign liabilities are compounding means that traditional safety nets are becoming entirely obsolete, transforming government bonds from low-risk instruments into high-exposure hazards. When national debts surpass critical mass thresholds relative to gross domestic product, governments find themselves trapped in a fiscal doom loop, where every attempt to service existing obligations requires issuing even more debt, thereby accelerating the depreciation of the currency unit. This mechanism strips away the purchasing power of the middle class without a single formal tax increase ever being voted on, acting as a hidden wealth tax imposed directly by monetary authorities. History shows that whenever sovereign debt reaches these unprecedented extremes, the eventual resolution invariably involves either a painful structural reset, outright currency devaluation, or a transition to a completely new monetary standard. Investors who fail to recognize this underlying dynamic continue to rely on obsolete playbooks that worked in past decades, completely blind to the fact that the rules of the global financial game have been fundamentally rewritten. Understanding this dangerous cycle is no longer reserved for Wall Street insiders or elite academics. It is an absolute necessity for anyone attempting to preserve their life savings and secure financial independence in an increasingly unstable world. As the foundations of global monetary hegemony fracture under the immense weight of systemic debt and geopolitical fragmentation, institutional investors are quietly repositioning their assets to weather the incoming economic storm. The traditional assumption that sovereign bonds and fiat currencies represent a risk-free store of value has been completely shattered by years of relentless inflation, irresponsible monetary expansion, and the weaponization of international payment networks. For everyday individuals attempting to navigate this treacherous landscape, relying on outdated financial habits is no longer just a suboptimal strategy, it is a direct threat to long-term financial survival. Understanding these profound macroeconomic shifts empowers you to take control of your financial destiny by diversifying away from fragile systems and focusing on assets with proven historical resilience. If you want to stay ahead of these unprecedented global transformations and protect everything you have worked hard to build, make sure you are subscribed to the channel so you never miss an essential breakdown. The cascading effects of this monumental shift away from traditional fiat systems and sovereign debt instruments are rapidly altering the risk profile for every single asset class across global markets. For decades, institutional capital has operated under the comfortable illusion that central banks possess an infinite toolkit to manage crises, smooth out economic cycles, and rescue over-leveraged financial institutions from their own reckless bets. However, the sheer magnitude of current global liabilities has rendered these traditional monetary interventions obsolete, transforming quantitative easing and emergency liquidity injections from temporary safety nets into permanent catalysts for systemic currency devaluation. When central banks are forced to continuously monetize government debt to prevent sovereign defaults, they effectively sacrifice the purchasing power of the national currency on the altar of short-term financial stability. This hidden mechanism of wealth destruction operates entirely outside the democratic process, stealthily robbing savers, pensioners, and middle-class wage earners who lack access to sophisticated hedging instruments or alternative wealth preservation vehicles. As public awareness of this structural flaw grows, the psychological threshold of trust required to sustain unbacked paper currencies begins to evaporate, triggering a silent stampede toward hard assets that cannot be printed, manipulated, or devalued by bureaucratic decree. This macroeconomic reality explains why institutional capital accumulation in physical commodities, precious metals, and decentralized stores of value has reached unprecedented levels, far outpacing the defensive postures adopted during previous financial panics. For retail investors and everyday citizens, recognizing this structural divergence between official economic optimism and grassroots financial vulnerability is the single most important step toward safeguarding one's financial future. If you want to stay fully informed on how these macro trends develop and how to protect your hard-earned assets from the fallout of systemic monetary failure, take a moment right now to subscribe to the channel and ensure you never miss our upcoming strategic breakdowns. The systematic erosion of purchasing power, driven by persistent sovereign debt expansion, has created an unprecedented divide between financial elites and everyday households trying to stay afloat in a volatile economy. While large-scale financial institutions and institutional allocators utilize complex hedging strategies, derivatives, and direct exposure to hard assets to shield themselves from currency debasement, the average worker is left entirely vulnerable to the compounding costs of inflation. This disparity is not an accidental byproduct of economic downturns. Rather, it is the direct consequence of a monetary framework that inherently favors those closest to the creation of fresh capital while penalizing long-term savers. When central banks inject trillions of units of newly created currency into the banking sector, the initial beneficiaries capture the highest purchasing power before prices across the broader economy adjust upward, leaving wage earners to absorb the full burden of higher costs for housing, energy, and basic necessities. This silent redistribution of wealth acts as a regressive tax, systematically dismantling the middle class and destroying the foundational incentive for genuine capital accumulation through traditional thrift. Consequently, understanding how to navigate this macroeconomic environment requires a fundamental shift in mindset, moving away from passive reliance on fiat-denominated savings accounts toward an active, diversified strategy centered around scarce, tangible assets. As these structural imbalances continue to widen, staying informed with rigorous, data-driven analysis becomes an absolute necessity for anyone determined to protect their financial independence. If you want to ensure you remain ahead of these critical economic shifts and receive actionable insights directly relevant to your portfolio, hit the subscribe button right now and join our growing community of informed investors. The systematic erosion of purchasing power, driven by persistent sovereign debt expansion, has created an unprecedented divide between financial elites and everyday households trying to stay afloat in a volatile economy. While large-scale financial institutions and institutional allocators utilize complex hedging strategies, derivatives, and direct exposure to hard assets to shield themselves from currency debasement, the average worker is left entirely vulnerable to the compounding costs of inflation. This disparity is not an accidental byproduct of economic downturns. Rather, it is the direct consequence of a monetary framework that inherently favors those closest to the creation of fresh capital while penalizing long-term savers. When central banks inject trillions of units of newly created currency into the banking sector, the initial beneficiaries capture the highest purchasing power before prices across the broader economy adjust upward, leaving wage earners to absorb the full burden of higher costs for housing, energy, and basic necessities. This silent redistribution of wealth acts as a regressive tax, systematically dismantling the middle class and destroying the foundational incentive for genuine capital accumulation through traditional thrift. Consequently, understanding how to navigate this macroeconomic environment requires a fundamental shift in mindset, moving away from passive reliance on fiat-denominated savings accounts toward an active, diversified strategy centered around scarce, tangible assets. As these structural imbalances continue to widen, staying informed with rigorous, data-driven analysis becomes an absolute necessity for anyone determined to protect their financial independence. If you want to ensure you remain ahead of these critical economic shifts and receive actionable insights directly relevant to your portfolio, hit the subscribe button right now and join our growing community of informed investors. The structural fragility built into the modern global financial architecture means that local economic downturns are no longer isolated events, but rather interconnected symptoms of a deeply over-leveraged system nearing its breaking point. As central banks globally find themselves cornered by persistent inflationary pressures and staggering debt service obligations, their policy options have narrowed down to a dangerous binary choice. Either allow the debt-based system to purge through a massive deflationary collapse, or continue expanding the money supply and risk a runaway loss of currency confidence. Historically, whenever monetary authorities are confronted with this impossible dilemma, they invariably choose the path of least immediate political resistance, opting for continuous currency expansion and hidden debasement over explicit default. This predictable reaction function is precisely why institutional capital continues its aggressive migration into hard assets, commodities, and alternative monetary networks that operate completely outside the control of any single central bank or political regime. For everyday investors, recognizing this inevitability provides a clear roadmap to step out of the line of fire, shifting focus toward assets with intrinsic scarcity and proven historical durability. Ignoring these macroeconomic warning signs or assuming that standard financial advice will suffice in a paradigm shift of this magnitude leaves one entirely defenseless against forces much larger than any individual market cycle. To ensure you stay fully equipped with the insights needed to protect and grow your capital through these turbulent times, make sure you are subscribed to the channel and stay tuned as we break down the critical steps for the final phase of this transition. The culmination of these mounting macroeconomic pressures points toward an inevitable monetary reckoning where the rules governing global trade, capital allocation, and sovereign wealth will be fundamentally rewritten. As sovereign debt levels scale heights previously thought mathematically impossible, the illusion of perpetual economic growth fueled by endless debt expansion is giving way to a sober reality recognized by top-tier institutional strategists. Governments and central banks are running out of runway, forced to manage a system where every incremental unit of debt yields diminishing economic output, while accelerating the degradation of purchasing power for everyday citizens. This systemic reality highlights why understanding macroeconomic fundamentals is no longer an optional pastime for finance professionals, but an absolute shield for anyone seeking to preserve generational wealth in a changing world. Those who prepare ahead of time by diversifying into scarce, hard assets and staying informed on structural shifts will find themselves uniquely positioned to weather the storm and protect their capital. If you want to make sure you never miss the critical final conclusions of this deep dive analysis, take a second right now to subscribe to the channel and stay ahead of the curve. The final phase of this historic macroeconomic transition will redefine the boundaries of global wealth, rewarding those who adapted early while penalizing those who remained tethered to a breaking financial system. As the curtain falls on an era defined by cheap credit, unbacked fiat expansion, and systemic debt accumulation, the shift toward a decentralized, hard asset reality is reaching its definitive tipping point. Navigating this new environment requires discipline, structural foresight, and an absolute commitment to protecting your purchasing power from the consequences of monetary policy failure. By understanding the core mechanics of gold reserves, central bank pivots, and sovereign debt cycles, you now possess the clarity needed to stay resilient when traditional financial pillars shake. Thank you for following this comprehensive deep dive series on the Wealth Outline. If you want to continue receiving high signal, unfiltered macroeconomic analysis that keeps your portfolio protected and ahead of the curve. Make sure you are fully subscribed, drop a like to support the channel, and we will see you in the next breakdown.